welcome everybody to webinar number 5, where we will sum up what are the key events from 2025 and look forward for 2026. I see we have 70 people. Well, Logan, Ted, welcome.
Thank you, Jakob.
Thanks,
Ted,
Jakob.
good morning.
On behalf of Yale Center Beijing, I just want to say welcome everyone, and to Logan waking up at 4:30 a.m. in Silicon Valley, to Ted on the U.S. East Coast, and to Jakob. Thank you very much for bringing this super popular webinar that you have done for the Global Network for Advanced Management to Yale Center Beijing, and to our audiences, as well as the SOM alumni and friends audience. This has garnered a lot of attention, tens of thousands of views each time. And we can't thank you enough to bring rigor and analysis to one of the hottest topic du jour, the economics of high-tech industries, and with both of you having a wealth of experience on arguably the two biggest economies and countries that matter in this space, US and China. So with that, really happy to be doing this last session for the year 2025. And we will look forward to more. We'll have a bit of a survey later on the call that Jakob will queue up to see what kind of interest we may have for keeping this going in a sustainable way. So, without further ado, Logan, we'll hand it over to you.
Thank you, Carol. And you touched on one of the themes that, as we look back on 2025, we really did focus on the G2, China and the US. And of course, we focused on high tech, and we feel like we got that right. Jakob, maybe you could put up the opening slide. As Carol did say, this is a look back at 2025 and looking ahead to 2026. Next slide. And I'm joined, of course, by Logan Bender. Logan, it's been a fun journey. We keep learning. We keep trying to figure stuff out. Thank you for being so engaged and supportive of everyone in the community. I hope you're doing well.
Thank you, Ted, for the intro. And thank you, Carol, again. Carol has been an excellent host. Her team has been awesome. YCB, we're really excited about these lectures. We try to do the best and put the best content forward. So let's jump right in. Ted, go ahead and kick it off, please.
Yeah, we couldn't do it without you, Carol. Again, thank you. And your team, amazing. So the agenda today is do a quick look at the performance of some Chinese and US stocks. And then, consistent with what our practice has been over the years, let's talk about a current event, which is the Trump administration decision to authorize sale of NVIDIA's H200 chips to Chinese companies. And then we are going to look at what we got right back in the previous webinars. And patting ourselves on the back, I'd say we got a lot right, not everything. And then looking forward, what do we think you should focus on in terms of big issues? And obviously, whether the US is in the AI bubble is a big one. I think a yet bigger picture issue that I want to really talk about is, are the US and China moving towards divergent AI ecosystems, or are they going to converge? I think it's a big issue for not just our discussion today, but not just for China and the US, but really for humanity. Which country will be more supportive of AI? Which of the two economies is more vulnerable? And then, as a favorite theme of Logan's, how should we expect private and public markets to interact? So that's our agenda. Jakob, do you want to just cover the first one? what do we see here with some Chinese and US companies?
The key insight is that the main Chinese stocks have performed very well this year to the surprise of Western investors and media. And as you can see in the chart, we put the year-to-date increases in stock value for these particular companies. The Chinese tech giants have outperformed their main counterparts in the US. Logan, back to you. What do you
Yes.
what do you
So if we rewind to 2024 and 2023, there was some depression in valuation among some Chinese companies. There was concern, growth concerns, there was regulatory concerns. We've seen more positive outlook among both US investors that invest in Asia and Asian investors. And so we've seen the rally in the Chinese counterparts of the NASDAQ. As a reminder, Ted and I really like to track both ecosystems on East and West. We feel that's very important to represent the global investor base, but not a lot of investors cover both. So we like to offer insight into both ecosystems, which is why we bring charts to this of this nature up. And we've seen other companies. Amazon's been relatively flat, even though they've had a lot of exciting growth initiatives. Oracle's been up and down. We'll get into volatility later, but we've seen a lot of volatility in the US tech space. Big wins, big losses, big news, regulatory issues. And so there's a lot there we'll unpack, but here's a performance year to date. Ted, if you don't have any comment, we'll move on to the next slide.
Well, the performance of the Chinese companies has really been impressive. We should note that the Chinese tech stocks lagged US tech stocks in previous years. So this is a reversal. And we know that stock prices reflect expectations about the future. So this is a significant change. Logan, you mentioned volatility and your connection with Professor Schiller.
Yes.
This, Professor Schiller, Nobel laureate at Yale, what he has emphasized to the world is that, yeah, stock prices may be efficient. We may not be able to outguess the market, but there's a lot of volatility, and I think that's noteworthy here. So let's go on to the next slide. What did we get right? Logan, you want to take the first two?
Yeah, let me take the first two. So, one major theme, and this was debated in the Wall Street community, both on the sell side, being the researchers, and then on the investor side, and among retail investors and academics like ourselves, is what's going to happen every quarter. We've seen CapEx, which is capital expenditure. So companies, and we're picking on the hyperscalers or the large cloud giants, the leading tech firms in the US and Asia. What are they spending every quarter on their capital expenditure? Mostly data center build out, buying GPUs, things of that nature, semiconductor related, to power and grow the AI initiatives. And we'll look at a chart going back to 2020 in a little bit, but the main idea is that when we got to the beginning of this year, 2025, that capex train had taken off, the trend had inflected. This was into the tens of billions of dollars every quarter. It seemed like these amounts were getting almost too big to stomach from a risk perspective in terms of deploying capital. And our view was that the risk of underinvestment and not being at the table to have a voice for the future of AI in the tech ecosystem would be far too risky, as opposed to trying to defend your capital expenditure decision. And we were right about that. We've seen record investment that's influenced other parts of the ecosystem, which we'll discuss later. But record capex did continue. We believe it will continue in 2026 again for similar reasons. And then I'll
Logan,
hit on number. Yeah,
Logan,
please.
could I interrupt? I mean, these companies, I think you're pointing out something profound, but it's also commonsensical. They're looking at the risks of underinvestment and overinvestment, and they see asymmetry. They don't want to be left behind. They don't want to be left without a seat at the table. Having said that, and they get into these heavy capex, you'll come to this later, but I just wanted to foreshadow. that one reaction or corollary to that is you want to try to de-risk your investments. And we're seeing a lot more partnerships and investments, reciprocal investments among these big spenders. So keep that in mind. Back to you.
Yes. Yeah. Thank you. Yeah. We'll look at the circularity of investment and possible implications and insight into that. But Ted's absolutely right. And think it in the back of your mind as well. We're going to hit on private markets a little bit less than some of our lectures, but in the private space, these companies, not only are they spending record amounts on CapEx for their own core business lines or new business lines, but they're also investing heavily in the venture ecosystem. They're doing corporate venture deals. They're doing other partnerships with private companies at a scale that we have never seen before. And that was breaking a record that we saw in 2024 about allocation of VC dollars in the ecosystem. So again, it comes down to the idea of are you missing a mega trend if you don't invest? It's easier to defend the decision of we spent too much money, but hey, look at what we could potentially gain from it. We'll talk about revenue traction in a minute, and I'll hit on number two that ties a little bit into number one. Is as those expectations have grown, valuations have followed in the public space and somewhat in the private space too. We've seen inflection valuations, larger rounds of capital had been raised. OpenAI, Ted, I was reading as we were getting ready for this lecture, I think 2 days ago, an article from the journal, and we printed in our current events, I think in 2024, that OpenAI hit a valuation of $80 billion. Yeah. And now it's $500 billion. A year later, I mean, these are mind-blowing sums of money. And so valuations, we thought valuations would be pressured in the public space to go up, and they did, absolutely. Though we've had volatility, they have risen. And I'll bounce it back to you for three. Go ahead on three.
So just an aside, what did I get wrong? I thought Amazon would do well. They're a laggard in terms of valuations of U.S. major tech companies. But turning to number three, we stated and we remain of the following view. The semiconductor industry is the most important industry in the world. It's where all the action is in terms of investment in data centers, how to develop AI capabilities. It's also, of course, so important to the fate of China and the US. So I think it was correct to focus both on the industry and on those two countries. Forgive me for apparently not saying anything great about the rest of the world, but I think objectively, it's really China and the US. It's we're not trying to ignore Europe. We're not trying to ignore South Asia, Latin America, et cetera. But it's really a sort of a heavyweight battle right now between China and the US. And as noted here, we've also been correct to say, okay, we have to realize this competition is in the context of rising global tensions. And we'll talk about that in a minute when we get to this current event. But I think we allocated our time well, and I hope that the audience has benefited from our focus on semiconductor, the G2, rising global tensions, and then, just note, I mean, we also stated along the way, if you were to pick one company in the world that was sort of at the epicenter of everything, we'd say it's TSMC. It's not the most valuable company, but it's the one that's really caught in these major trends in terms of investment in AI, CapEx, and rising global tensions. So, and then Logan has really kept me up to date on private markets. Maybe you would cover the last topic and why we think it's important.
Yes, no problem. So paying attention to private markets, this really struck me in 2025 in particular when we looked at all the venture dollars that were summed up essentially and deployed into the US venture ecosystem AI related or AI specific bets, I guess, and then ancillary, so hardware and software, different AI applications, swallowed up over half the venture dollars in the US in 2025. And I think about a third of it in 2024. And these are record sums of money. These are not trivial sums. These are in the hundreds of billions of dollars of capital. And so you have seen an extraordinary bet on and a wager on the growth of AI being the next mega trend. And that has led to huge valuation increases in the private markets. So much so that some of these private companies have gotten so big that they are starting to influence quite a bit the policies and operational decisions of public companies, which is kind of flips the script from before, where you had the S&P 500 and the tech giants. They would not talk down to, but they would collaborate on their terms with private companies that were later stage or emerging competitors, and that's not necessarily the case anymore. In fact, you see private companies that are they would say that they are ahead or they are leading or they are the dominant firm for now. And Ted and I are very careful about using the term dominant in tech because that never really seems to be truly dominant long term. But you get my point. And so I think that it's important to understand how much ballast the private markets have right now in the tech ecosystem. It's more than we've seen in a long time. So we'll conclude on that point. I think, unless Ted, you had another comment, we'll move on.
No, I think we should go to some of the proof points that we think are important. Um, on the global tensions, I'll just draw your attention to the lower left-hand um, headline. The restrictions on the sale of NVIDIA AI chips has led to a lot of tensions, contributed to the global tensions. It's also consistent with basic economics. If you put in a restriction, there are going to be efforts to evade the restriction. So this particular headline claimed, the story claimed that there was $1 billion worth of NVIDIA chips being moved into China despite the ban. But let's go on to the next one. This
I'll
is
take this
this is a
one. Yeah.
proof point for Logan's point, and maybe you could talk through this slide. This is one of our favorites.
Yeah, this is a slide. We pulled this from the Wall Street Journal, and we've pulled this slide as we've gone on in the class that Ted and I taught at Yale, which is looking at the capital expenditure, what we referenced earlier. This is CapEx by quarter for the above four names. We have Meta, Alphabet, Microsoft, and Amazon. If we were to include Oracle and some other companies in there, we would see this obviously increase. But this shows you the steady march in CapEx spend. Every quarter it goes up. And if you look at the scale on the left axis, you see this is eclipsing $50 billion per quarter. These are huge sums of money. And let's also remember, and the reason why I want to hammer this home is because the revenue realized from these initiatives is much less than the spend. We have not seen any of these companies achieve a positive ROI relative to the amount of CapEx that they've deployed. And so this is on the hope that this will be, yes, Andy Tan, yes, thank you. That's a lot of money. That's absolutely correct. That's what we're saying. But the revenue realized from this spend hasn't been there hasn't been as much traction as some people hope, which we will then talk about in the potential AI bubble. Jakob, if you could move to the next slide, please. We'll take another look at this from another dimension. Let's put this in perspective. These tech giants in this basket of companies are investing 40+% of their revenues on CapEx related to semiconductors. And so, as Ted mentioned, TSMC and the conversation around the G2, the near and medium future is hinging on the semiconductor industry. It's the most important. I believe China is going to announce their 5-year plan. And let's also understand that semiconductors, not only do they impact the AI, but they impact biotech, they impact quantum computing, they impact automotive. Ted and I had a lecture a couple of months ago about how much technology is hinging and dependent on semiconductor content. And we've seen the inflection really kick off in 2023, and we've seen 3 record years of capex. And then let's take a quick peek at 2026. Jakob, next slide, if you could, please. Let's look at 2026. And so this is a little bit of an eye test. This expands the basket. CoreWeave is a data center company that has come to IPO fairly recently. And so these are what are called hyperscalers, largest kind of cloud giants in the US tech basket. When we look at 2026, we see this is consensus estimate about a continuation of this capex trend getting even bigger. So as much money as they have spent year to date, quarter to date, last year, the year before, there's still spending, and we believe we are with consensus in this way that we believe that capex will increase in 2026 and it won't slow down materially.
And
And I think that wraps up that section. Yeah, go ahead, Ted.
Logan, we infer, even though we don't have the data on Chinese spend, we infer that the Chinese are spending as much or more.
Yes.
And why do we?
That's right.
You'll see this later in one of Logan's slides. The amount of power generation capacity that China has put in place, it's now growing at a really fast rate. Total capacity in China far exceeds the US capacity. What is that capacity being used for? We believe it's for data centers, but we don't have data by company, so that's why we're not showing a companion slide here. But this is clearly not just a US phenomenon.
Yes, yes. All right. Let's go to the next slide. Ted, why don't you kick this one off? This is current event of the day.
Yeah, I called out that headline about $1 billion worth of NVIDIA chips being smuggled in. But the US has pursued what some people in the US call a containment strategy, where they've tried to limit China's development of leading edge technologies, especially those related to AI. How have they done that? By picking out NVIDIA chips and saying, oh, those are the things that really influence whether the US has a lead, whether China has a lead. And just in the last 10 days, the Trump administration has reversed that containment policy, and it announced that the US would, going forward, allow NVIDIA to sell their H200 chips to Chinese companies. So this is a significant shift from prior policy. Trump, consistent with what he does a lot, he said, we want to take a piece of this. So there's, in effect, a company-specific, product-specific export tax on these chip sales. But Logan, maybe you could try to put this into perspective. Where do H200 chips fall in terms of NVIDIA's current product portfolio and future product portfolio?
Yeah, so the H200 is not NVIDIA's leading edge semiconductor, meaning what's coming in 2026 and 2027. This was launched in 2024, maybe late 2023. And so an H200 is a name of a chip, but what the Trump administration or the US is saying is that they are concerned about a performance threshold that they're allowing China to use or allowing NVIDIA to export to China. And so that's the concern, is the amount of power that they're giving them that these chips have. That doesn't mean that China can't buy a lot of them. But the H200, one could argue, since it's not the leading node and it's not the most powerful chip to come, is it okay to give it to China? Is kind of the counterbalance to that conversation. Instead of saying, well, we're giving away everything, and we're giving away the farm, and then we're going to be outcompeted because we're giving away our best chips and our best in breed horse. Not necessarily the case. This is not the leading edge. And so I think it's important to note that, Ted.
Yeah, and on the last point, it's potentially a huge boon for NVIDIA. Their stock price rose immediately after, not surprisingly. But there is some doubt about whether Chinese companies will be allowed to purchase these chips and which Chinese companies in which volumes. And Xi has said he's been very clear. He wants the progress in China to be built on Chinese foundation, not the US foundation. So I think there's uncertainty about what this really will mean in practice. But I've been following the US reaction to this, and the US reaction is negative. And here are just a couple of examples of US media saying this decision is wrong. And the Wall Street Journal and the New York Times rarely agree on things like that, but they do on this issue. They basically say that allowing the purchase of these chips will give an advantage to China that they lack because the H200 chips are better than leading Chinese chips. That's an important fact. They're better. So, as Logan said, the performance of these chips is better, and that'll allow applications to develop in China that otherwise would not develop. Um, and that concern, if you read the U.S. policy commentary carefully, a lot of people who share this consensus negative view are focused on military, national security, data security issues. Um, so that's basically the negative consensus. Let's go to the next slide. I'm not going to try to convince you whether the U.S. consensus is right or wrong, but I think Logan and I would like to lay out an alternative view of this. Um, and critical thinking is needed here. And I think it begins with a couple basic facts about chips. Nobody consumes chips. They buy chips, but chips are purchased because they're used in the context of hardware and software to produce services. So NVIDIA they design these chips. TSMC is their major supplier of these chips, but NVIDIA is not just a supplier of chips. They're not just a hardware company. They're not just even not just a hardware company, not just a software company. They develop ecosystems. So Logan, maybe you could explain a little bit about the so-called software stack and maybe the hardware stack so that we can get a deeper appreciation of this point.
Yeah, so yes, for context, and so we look at a company like NVIDIA, which is essentially an IP designer. By the way, they have a marvelous venture portfolio. They've invested in a lot of interesting technologies. So I think NVIDIA's branching out. Obviously, their robotics is phenomenal. But I think what's missed on the news when you read articles and things like this, and sometimes in the analyst community, people often miss that NVIDIA's programming language, CUDA, their CUDA ecosystem, has grown a generation of engineers, not 1 or 2 years or a software update or a patch or something like that. That there are hundreds of thousands, millions, in fact, I think Jensen referenced in the millions of engineers that use the CUDA ecosystem. And so that's a much more broad set of individuals working for interesting firms all over the world, US, Europe, Asia, et cetera. And so we don't want to constrict our audience to think that NVIDIA is just the hardware that they're designing and then TSMC is printing out. It's actually an entire ecosystem of software as well, Ted. So it's an important understanding to have that context.
So the economics here would emphasize the complementary investments that users make in a hardware stack, software stack. And the more, I think, subtle question is, how does this affect the development of the Chinese ecosystem? Will the NVIDIA chips be used and embedded in the Chinese ecosystem, or will there be a tendency to also see that the ecosystem in the US around these complementary investments will play a greater role in China because of this policy decision. And the counter argument to the U.S. consensus being negative is by giving access to these chips, we're going to encourage investments, complementary investments in software and hardware that match and relate to the US ecosystem. So if you think about this not as a battle over who's got the leading chips, but who's developing the better ecosystem, what we need to understand is that there are transitory issues here. Yeah, we're definitely giving China the opportunity to buy better chips, but we're also maybe over the long term encouraging Chinese investment in complementary products, software and hardware that will sustain U.S. leadership in the overall AI space. That's the counter argument.
Mhm.
And another counter argument is we know China is working diligently. They're allocating massive amounts of financial capital and resources to developing chips that are better. And I can't predict that. I can't predict their path of success. DeepSeek has said Chinese chips are definitely, behind the U.S. chips. But a question that I think is relevant to this policy question is how long would the advantage last for the U.S. if we deny chips, try to, you know, put a clamp on all the smuggling? That's going to encourage greater Chinese efforts to develop chips that match and potentially leapfrog and exceed the capabilities of NVIDIA chips. So I don't think this is a easy analysis, but simply for the U.S. naysayers, the people who are negative to say this is obviously bad, I think it misses a lot of these important points. All right, let's move on to 2026. I think this is the first one is on everybody's mind, right, Logan?
That's right. That's what everybody wants to talk about today.
Let me start it off by saying, given what Logan said, we got these massive investments by hyperscalers in the US. We have to ask the question, will they pay off? And to underscore this question, for those of you who followed Logan and my teachings over the last several years, there's a phenomenon called hockey stick high-tech companies. And usually we think of the hockey stick profile as being for startups. And the idea of the hockey stick is the companies start up, they spend a lot on capital, they make a lot of investments in their products and services, so they have negative cash flows. They have negative profits. And the idea of the hockey stick is hopefully that downward negative profit trend gets reversed as you get into the sales and get penetration into the accessible market, with the result that the profits go from negative to not getting as negative to flatten negative and then turn up. Why do we bring this up? I think this what Logan said is really important. The capital expenditures by these US firms are so high, they're far exceeding what they're bringing in now in terms of return on investment and revenue generation. Hence, it's correct in our view to think of these US hyperscalers as having within their product portfolios a startup, a massive startup that's a lot like a hockey stick profile. Now that means a lot of things, but one of the things that investors are concerned about, how many of these top US companies will make the turn? And for that line of business, if you want to think about it that way, how many of them will actually be able to make the turn into profitability for that segment, that all important segment of their business. That I think is what's behind all these concerns about, is the US in a quote AI bubble?
Yes. All right. So let's jump into this. Can we please go one slide back, Jakob? Let's look at the 2026 items just so the viewers can get a scope of what we're going to cover today. We'll do the AI bubble in just a second here. We're going to discuss, Ted's going to weigh in on this as well. Are we moving towards a divergent AI ecosystem, or are we converging into a primary ecosystem? Which country would be more supportive of AI development? That's top of mind as well and important, especially in the news these days. And Ted's going to lead which of the G2 economies is more vulnerable, all this being said. And then I'll lead and Ted will comment on the roles of public and private markets as we step into 2026. Sound good? All right.
Good. Let's go.
Jakob, go ahead and go to the next slide, please. Pause here for just a second. No, on the title slide. So one more slide back. Yes, that one, please. All right. So let's think about. Let's just frame this for a second. So there's a lagging statistic, but an important statistic that we put in one of our lectures, that the energy consumption of the state of Virginia, almost 1/4 of that goes to power data centers alone. Now, I pick on that because Virginia is a very data center friendly state. You have a lot of water and land and all the stuff. It's near the government. However, that's a tremendous amount of energy. That's a tremendous amount of resources to build it. We're now seeing data centers pop up in North Dakota all over the place. And so it's not just the idea of a data center housing computers. These are changing the local economies and the energy infrastructure into the foreseeable future. So this is a mega trend, and to build what? To power what? When we do tokens, I help my daughter with her algebra homework every night, and I'm consuming data center tokens, and somebody's electrical bill is going up in Virginia. Example may seem trivial, but this build out is historic. And this amount of money, I think, exceeds all of the money the US spent in the entire US interstate system for like 60 years or something like that in the last 2 or 3 years. There's a great quote in one of the news articles recently about that. And so let's just imagine that this is a huge event. This is deploying, tens of thousands of individuals, hundreds of billions of dollars of capital, and it's accelerating. It's not just we're building it now and we're going to stop. It's going like this. So with that in mind, let's go to the next slide. Let's look at the circular investment ecosystem that we're in right now. All right. So increasingly, we have seen what's referred to as circular investment. I'll give you an example. NVIDIA agreed to invest $100 billion in OpenAI, and OpenAI agreed to purchase, 300 billion of computing power in Oracle, and NVIDIA and OpenAI and Oracle are doing deals all with each other. Amazon is investing, buying NVIDIA chips. Microsoft is investing in OpenAI. And so you see historic amount of deals being done, over $1 trillion of deals just with OpenAI alone. OpenAI is not publicly traded. It's a private company. We've never seen that behavior before. And on the right-hand side, the first point I have is lane convergence expanded. What would Ted and I mean by lane convergence? Well, when the AI inflection really took off in 2023 and has grown since then, obviously, the behavior that we saw among the Mag 7 in particular was that you had these companies go from having their core lines of business. Google does 95% of their revenue from search. Amazon does e-commerce, etc. To now you have kind of an open field. Anybody can make a search engine, anybody can have an LLM, and they can be quite competitive with the others. And so instead of everybody staying in their individual lane, it's the analogy we use is it goes from swimming lanes to more like water polo. Now you have this kind of beehive effect where a lot of different companies are competing for similar lines of business or emerging lines of business like they never have before. Fast forward to 2025, what we're also seeing these very large private enterprises, private companies that are very well funded, also partly funded by the public companies that they may be competing against. And so we have this lane convergence expanded idea. And so, what's the risk of circular investment? Well, we're seeing some of those risks emerge in valuation concerns. Oracle has been in the news recently. They took a big hit to their share price because they had delays in their buildouts. That sends a shockwave or a ripple effect through other parts of the ecosystem. Hey, they promised all this spend of this capex. Now they're pulling back or there's delays on it. So we're not going to materialize the revenue. Hey, this deal that we were supposed to do, well, that's on the rocks now. When I say on the rocks, I mean it's pushed out or it's held there. It's not happening anymore. And so if you have circular investment that drives up expectations of earnings and drives up valuations and something stumbles, it can have a cascading effect through the ecosystem. And so investors and analysts get worried and nervous when they see a lot of circular investment, like a vortex. And we're seeing that right now at incredible scale. I mean, incredible scale. There's no other way to describe how big these sums and expectations are. We just haven't dealt with these sums of money before in the markets, and so expectations are very high right now. That leads to the idea that maybe this is bubble-ish. Okay, so another important point is at no time in history have we seen such large private companies push storytelling and narrative because stories matter. What we're telling you in expectations. Ted and I signed a deal for $100 billion over 10 years. What if in year 2 we get divorced and we go our separate ways? And that $100 billion expectation just goes poof in the wind. And we've seen that writ large. And so private companies are influencing public companies to make these spending decisions, and it's driving investor behavior, driving expectations. And so the question that we have, and I'll leave you with, is this strategic interdependence or is this artificial increase in value? And are we going to see circularity reduce risk or increase risk? And so think of the swimming lanes analogy, think of lane convergence expanded, and you have a lot of different companies competing for browsers, ads, LLMs, things like this, different applications, applications of different software companies. Now you can go out and you can build a Microsoft Excel clone essentially in your apartment in, downtown Manhattan. What a concept. And so circularity of investment could lead to tremendous growth potential because they may all work together to create much more growth in productivity. That's on the positive side. On the negative side, you could see cascading effects when expectations start to pull back, Ted. Let's look at another slide, Jakob. This is a much more simple. Yeah, Ted, please.
Could I slow you down there, Logan? So let's just pause a little bit on the artificial increase in value. I make a deal and I promise to invest in you, and you promise to buy goods and services from me. Neither of us are CPAs, accountants, but the issue that arises in that context is when do the sales get booked? And how do the analysts evaluate the promise to buy maybe $10 billion worth of products and services? And what Logan is saying is, well, it may be over 5 years. How does the accounting work? What happens if the deal falls apart in year 2? That's sort of the an example, a little bit deeper insight into the risk issues. And the other thing I would just point out, if there's uncertainty, which we believe there is, about which of the US companies are really going to succeed with AI, then from a risk perspective, rather than just bet on yourself, it makes sense possibly to spread out your bets and bet on some of your co-operators, competitors, rivals, partners.
Yeah.
So Amazon just announced $10 billion investment in OpenAI. OpenAI may be the most successful company this past year because they went from nonprofit to profit. They've remained private. And as you pointed out earlier, their valuation is skyrocketing. It's now 500 billion. So if you're watching AI and you're one of these leading companies, you're saying, well, maybe I should bet on OpenAI. Maybe I should think about that as a way to reduce the risk of the competition for me. So I think that's a little more detail about why this is such a big issue. The circularity, is it really strategic interdependence? Is it just risk reduction? Or is there also artificial increase in value? And I think I don't know if you agree, Logan, it can be a mix of all three.
It's a mix of all three and well put. And back to the idea that this is narrative driven. This is a story. We have not seen realized revenues yet. As Ted mentioned, how are we booking the revenue? I promised Ted $100 billion. He promises me $100 billion. Do we book that today and just assume that's going to all work out? Not necessarily, but that's a story. We're making each other a promise, making each other a deal. Materialization of that is TBD. Let's take a step back and look at it from a simplified perspective. Again, narrative driven. What's the narrative? What's the story telling you? Stories drive economic events. Okay, this is a Google search. This is Google search of AI bubble. Look at the chart. Look at the right hand side. Look at the spike. Oh my goodness, that's something. And so this is AI bubble. They've declined in recent weeks, or excuse me, in recent months since the spike in the summer, but they've ticked up. So, but this could be anybody from your uncle at a holiday party to a person like Ted teaching a class like this. Let's jump to the next slide and look at what's happening on the institutional side. So these are charts. I'll break these down. So the chart on the left is the AI and AI bubble as are mentioned on Bloomberg terminals. Bloomberg terminals are what we use on Wall Street to, one, communicate with each other. It's a network, but also to look up any stock ticker or stock price in the world, any news event. We use scrapers. It is the central tool of an analyst. You have your Bloomberg terminal, you have it on your phone, you're connected to it 24 hours a day. You live and breathe through your Bloomberg terminal. The reason why this chart's important, in my view, is that this shows you that institutional investors and analysts are also searching for this a lot, and they're reading about this AI bubble a lot. Then the chart on the right is also important because this is the amount of S&P 500 companies that are mentioning AI on their earnings calls recently. And this chart goes back a ways. And so it's a bit of an eye test. But if you look on the left axis, you see that about 50% of the Fortune 500 is mentioning AI in their earnings call this last trailing quarter, Q2 would be. And so that is, it doesn't necessarily, it's not indicative of bubble behavior, but it shows that this conversation has grown to the highest levels of corporate and it's trended up. It had a huge spike up after ChatGPT was released. You see that inflection in 2022, Ted, in Q2 of 2022, that spike up. That's when ChatGPT was launched. So these two charts, I think, illustrate what's happening in the investment world and the corporate world, as well as the retail world, which was the slide before. If you have a comment, Ted, let it fly. Otherwise, let's move to some different sources of capital, which I think are pressing right now.
Yeah, I think no. Let's move on. I think not surprising given what we've said. U.S. big tech companies need more capital, and they're looking at sources that in the past they didn't look towards. So this pretty much speaks for itself. But again, think of this as individual high-tech companies being hockey stick. They're attracting investors in the hopes to have this return, this penetration into the market and get revenues. Let's go to the next
Yep,
slide.
and I'll comment. I'll comment on this quickly. Historically, it's not common for tech companies to take on debt.
Right.
Just debt is usually not part of the balance sheet item, even at IPO, even when you meet companies at IPO, and maybe when they're later stage after IPO, they'll take on some debt. But this is so we've invited a lot more sources of capital. You have asset-backed securitization, you have straight up bond issuance. And so the pool of investors has expanded materially to fund these initiatives. So this is a trend that I want the audience to pay attention to in 2026. This is going to be important, in my view, going forward. All right, Ted, let's wrap this section up. I think we have one more slide on this. Yes? Okay.
I
So
think I
all
think we
that,
should probably skip this, but I think you've already covered it. I mean, the importance of narrative and will these companies be able to work their way out of the bottom part of the hockey stick?
Yep. All right, next slide.
I wanted to spend some time on this one. And thank you, Logan, for unpacking all that stuff about
Yep.
the bubble. I think it is on everybody's mind, but hopefully now the people who are listening in have a better way to think about it. You pay attention to the private capital markets, the flow of funds, what interest rates are U.S. companies paying for this additional capital, et cetera. Um, so, I think one of the benefits of being a little bit older than most people who are following the tech industry is that I have a longer term perspective, and the AI discussion to me was sort of muted 5, 10 years ago, but it became much more important. Um, and I think it's proper to think about this as a major fork in the course of human history. Humans have been around for a long time, and it's all been natural, what we refer to as natural intelligence. And now we have something called artificial intelligence that's moving not just into applications, but into generative AI, producing new ideas, works of art, music, writing, etc., and even going beyond generative AI to superhuman intelligence. So, given that we've already had this fork, natural intelligence and artificial intelligence, and given that let's just pause it again, AI is really right now, it's a battle between China and the US. It's the G2. And the reason why we put in the Trump administration policy change is that I think it within that fork of AI, we now have another fork. And the second fork is, are we going to have a convergent ecosystem for AI where even though we're rivals, China and the US share insights about AI, they share insights about how to invest in complementary assets like software and hardware, protocols, et cetera. And there's exchange of ideas and leading edge human capital. Or are we going to get divergent ecosystems with China and the US? Um, yeah, I'll just reveal my hope and maybe my fear. My hope is these ecosystems don't diverge for the most part. I think it's much better if we have one global ecosystem for AI. And I'm concerned about the idea that we're going to maybe, this is not, this is not just saying the US doesn't want TikTok. It's not just, China doesn't want to have Google, right? As a search engine. This is much more profound. This is how does each country move forward in developing AI and applying it. Now, I think there's an argument for having a common ecosystem in large part because the two countries are emphasizing different strategies. China is much more focused on applications, leveraging their huge advantage in manufacturing, um, and I think increasing that advantage. And the U.S. is much more focused on generative AI and superhuman intelligence. So I don't think there's rivalry in terms of use applications as much as one might think. So I think this is not so much just an issue for this coming year, but think about the path dependency and where we're headed. and ask yourself 10 years from now, where are we going to be with these two different, strategies and potentially two different AI ecosystems? What would that world look like? What's the effect on societies around the world? So that's my,
And I'll
big look
yeah,
forward.
yeah, I'll jump in on that as well. So one way we can break it down a little bit more is hardware divergence and software divergence. We have seen hardware divergence. China does not have a native GPU. They have to buy them. Their memory industry is lagging. They don't have a native CPU. But then on the software side, as Ted is pointing out, are we going to see two internets? Are we going to see two digital economies? Are we going to see two different AI ecosystems? One could say that LLMs diffuse globally, albeit indirectly, over time through academic research and people and use cases and things like that. Talent is fairly moves around. Are we going to see open source models being a bridge between the two? Possibly, but think about it also. In addition to Ted's comments, hardware divergence versus software divergence. Back to you, Ted.
So we started at 35 minutes after the hour, and we said we'd go for about an hour. So maybe we could be a little bit quick with the remaining big issues, and try to get done in 6 minutes. But I think one question is which country will be more supportive of AI development and all that it entails? And I think let me just highlight it should be number four, actually, the bottom one. Um, US politics is starting to solidify and potential opposition against more data centers. Senator Bernie Sanders has come out in favor of a moratorium. That means stopping investments in data centers. Individual cities and in states like Arizona have said no more. Uh, Georgia, people are really upset about rising energy prices, and they're blaming data centers, and they're probably right. Um, so this support for AI is multidimensional. What effect is it going to have on jobs? What is it going to do to society? What's it going to do to higher education, K through 12? Energy is a real flashpoint in the US. I don't have insights into how much support there is for um, AI development in China, but my guess is because it's being complemented by their strength in manufacturing, it's not as big of an issue. That's just my intuition. We'd love to get your insights. In terms of the higher energy prices, I alluded to this earlier. Whatever we're saying about data centers being added in the US, we infer that from this slide that the investments in data centers by China are even greater. Look at this chart. I mean, this starts in 2010. The lines cross, and China now is many more times has many more times greater capacity for power generation and therefore data center investment. Next slide. So one question for the next calendar year and beyond is, which of the G2 economies is more vulnerable? And I think the strength for China is their manufacturing advantage. That may get so large that there's a backlash in Latin America and South Asia, East Asia, Central Europe, Eastern Europe, Western Europe, et cetera, around Chinese manufacturing is leading to massive exports. And I think there's naturally going to be tension where there's a domestic industry that competes against China. So, but I think we'd start with that as an advantage. And then everybody knows China's vulnerabilities are in public debt, property crisis, and weak consumer demand. The U.S., its advantages in the areas I mentioned. I think a big concern that a lot of people have in the U.S. is US policy seems really chaotic, meaning haphazard, not consistent, not explained very well to the public. So I think that's a big issue for the US. And plus, of course, the AI bubble. Let's go to the next one. Logan, I think this is our last one.
Yes, I can cover this pretty quickly. We've highlighted a lot of these points, Ted, so I think we're good on this. I'll just say that leading AI firms, they're influencing the conversation like they never have in the past, with incredible size and investment from their cooperators, as Ted mentioned, or potential rivals. They're swimming in the same lanes. We've seen lane convergence, so pay attention to that. Pay attention to the capital rounds that they're going to raise. This will lead into the conclusions on the next slide with the IPO window coming. We're going to see some IPOs in 2026. So big things happening in the private companies. Ted, you want to take number 3?
Uh, no, I think we covered that. I think
I think we're good. Okay.
we don't have as much in the way of lines of sight and insights into the interaction between public and private companies in China, but clearly both are important right now. And so, Jakob, should we turn it back to you? Oh, conclusions
Oh,
first. Yeah,
yep.
we'll continue if we go forward, focused on the G2. We'll continue our focus on semiconductors. This is TED speak, but I believe what's happening right now is going to influence the course of human history.
I agree.
We'll of course pay attention to the AI bubble. The IPO window is open. Private markets will continue to play a big role. Logan is right. I mean, the narratives around AI bubble, they're so important to follow and understand who's got an authentic, supported, fact-based narrative and who doesn't, especially given this interdependence and the circularity. You got to go beyond just the announcements of big deals, whether it's Oracle or
Yeah,
Amazon, et cetera.
that's right.
But we do think the CapEx boom is going to continue. I think the asymmetry that Logan pointed out, it's better to be wrong on the upside than wrong on the downside, is driving this for US companies, and we suspect for Chinese companies as well. Okay, so Logan, thank you for your insights. This is really a lot of
Yes.
fun to try to put this together.